Hi, welcome to Retiring Well, folks. We got a great show lined up for you today. Today we're going to be talking about the elements of an income plan. What are all those things that go into that plan when we draw it up? A couple weeks ago we talked about marketplace subsidies. I want to re-show that episode because it's very important that you don't miss it if you did a couple weeks ago. We've got an old episode we have about Ask Banks. You know, Mike Reese had his dog on, and he had picked some stocks and actually some commodities, I think, and he actually came out ahead of what the market did in that month period, but we want to talk about that. Exchange traded funds, what are those? All right, initial public offerings, you hear a lot about those, so we're going to talk about that too. So folks, stay tuned, we have a lot to show you.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Hi. Listen, one of the things we do at Centennial Wealth is what's called income planning. Now, we have the tools to be able to, take a number of different factors and basically build a plan. Now, I want to talk to you about all the elements of things that go into that plan. It's quite extensive, actually. The first thing we want to know is if you're working, right, how much longer do you plan on work? How much are you making right now that can contribute to your retirement savings? Basically, how much are you putting away maybe in that 401k and those IRAs each year, comfortably? And then how long are you going to work and how much will that be? Social Security. What does that look like at age 62 if you take it early? What is the amount at full retirement age? How about at age 70, right? We're going to want to factor those things in. When it comes to Social Security, there's a cost of living adjustment associated with it, meaning, it goes up over time with inflation. We want to certainly reflect that in the income plan. And then, we're going to have to use an assumption rate there. The inflation the last 10 years, maybe the last 40, don't know. Pensions, annuities, do you have any income that's coming in that's guaranteed other than Social Security that we should be factoring in? And does any of those pensions have a cost of living adjustment associated with them as well, right? What about your investable assets? How much do we have put away in savings, those 401ks, IRAs, or other accounts, right? What growth rate assumption are we going to use for those assets? What are they going to grow by year? How about passive income? Do we have rentals? Do we have business income that we can count on for a period of time? What does that look like? And then, probably the most important question in an income plan is how much income are we planning for? What are your income needs? How much is it that you need to get by on? Maybe we need to put the pencil to the paper and do a budget, right? But we're going to need to know that number. And then once we've established what those income needs are we going to grow that with inflation, right? What it takes to get by today isn't going to be what it takes to get by tomorrow, right? So we're going to want to reflect an inflation rate with that. How about taxes? We might know what the gross amount we want each month is or year, but are we reflecting taxes into that figure? So we want to do that as well. And then let's reflect on, is there anything that might change from a cash flow standpoint going forward? Am I going into retirement? I still got a small mortgage payment. If that's going to be paid off in the next 5, 6, 7 years, can we reflect that in the plan as a positive? How about if we're going to downsize our residence? Sell that and then have a little bit of money that can maybe go into savings. Let's maybe reflect that. Folks, when we do an income plan, you can see there's a lot of different elements involved. What we're really trying to do is build a plan. We want to make sure that you're not going to run out of money. All right, it's going to last you at least age 100 with the way people are living longer today. As far as scenarios, we can run a number of different scenarios. That Social Security early, that Social Security late, all those factors. And then once we build a plan, we want to continue to monitor that plan, which is very important. So if income planning is important for you, obviously give us a call. We'd be glad to help.
I think that was really valuable what Larry shared as far as mapping out a long-term income plan, and it's something at Centennial Wealth Advisory we have the different tools to help map that out because it's so vital to see, hey, what do the next 20, 30, maybe 40 years look like for your retirement plan, and it doesn't just come back to what you have saved in your portfolio. So often people are focused primarily on the investment side, but ultimately, you know, you have to generate a paycheck from those retirement savings and make sure that that money lasts for your lifetime. And that's where, Nick, I know we use that retirement analyzer tool to help us in giving a visual to everyone. If you don't mind, talk a little about that.
Yeah, so it's so beneficial because it really does paint that picture through the 30 years plus of retirement. It's really neat that we can put in all your different income sources, Social Security, any kind of pensions you have, and then we can also map out your expenses too. So that mortgage payment that, hey, might be going away in 7-10 years or so from now, we can show that and what it actually looks like and how that affects your income expense ratio later down the road. And then also, we can put in different rates of return. We always go on the conservative side. So maybe it's a 4% rate of return, or maybe even a little less. So you've got that cushion there, so hopefully we do better than that, but you never know, right? So it's really neat. You can look out and say, oh, at 100 years old, I'm gonna have X amount of money for my beneficiaries if I pass away. So it's a really cool program.
Yeah, that's a really good point that Nick brought up of, especially when we're trying to build that long-term plan, we'd rather err on the side of caution. Yeah, anybody could say, oh, what if you average 10% returns and everything would look beautiful, I'm sure, but let's err on the side of caution for that and make sure that that plan's also going to work for you. Along with that, some of the things that it factors in is taxes and what that looks like. Now, it's based on what tax rates are today. Nobody knows yet what that'll look like long term, but it does factor that in, which is, again, another vital piece of your retirement plan. So stay tuned as we're going to be diving in next to marketplace subsidies.
What are these expense ratios you find in mutual funds? Most importantly, how much risk can you take on? I want to talk to you about Social Security, the estate tax exemption, ladybird deeds. What are they? Modified adjusted gross income, tax bracket optimization, the sunken cost trap, 529 plans, the financial cycle, the Federal Reserve, income planning, tax planning, holistic planning, fees, bonds. Can I retire? Hi folks, listen, out of the American Rescue Plan that came out in March of 2021, there's some things that you definitely want to know. Now, Ben, you're my son, all right? You happen to work here at Centennial Wealth, and you are right now specializing in the health insurance area, right? And you brought this to my attention, and folks, this is something you're going to want to pay attention to, because if you're out there getting the marketplace insurance and you're receiving a subsidy, then you're going to want to hear this story. So Ben, tell the story. You had a couple come in, they heard something that came out of this plan, and then you were helping them.
Yeah, so interesting story. We had a client who gave us a call. They were looking for, had heard about this American Rescue Plan, had a friend who told them, hey, we saved $200 very easily, gave us a call. I met with them the other day, found out to be very easy. We went right onto healthcare.gov, and from there we were able to get them reapply for the same plan they were already in. Within a 10-minute time frame, we had them signed up, and lo and behold, they were able to save themselves $200 as well.
Right. And when you told me that story, I was like, I didn't ever even hear that came out. So we have, folks, there's a lot of you out there that are getting this subsidy, and all you have to do is go on the site, right? And we're going to post that up. If you go to the website, hopefully you can remember your username or password, right, so they can log in. But if you can't, I understand you can actually call too, right?
Yep, so they have a 1-800 number. You can find it right on the front page of healthcare.gov. And from there, they can help you reapply right over the phone. In the case of these clients that had come in, they had forgotten their login, hadn't used it in a long time.
So we tried getting them logged in. We weren't able to do that. Had them call the 1-800 number that's right there on the page, and they were able to help them, a representative, right over the phone.
Awesome. All right, so we're going to post both that, the website and the 1-800 number up here on the screen. Now, folks, if that's you, certainly, if you want any help with this, you want to give us a call. Ben would be glad to help you with that. There's another group of you out there, though, that did not qualify for the subsidy because your income was over the threshold. Well, something else that came out of that plan was that they raised that level. So, you know, where it used to be 400% of the poverty level, it's now like 1,300% of the poverty level. So if you weren't getting the subsidy, you may want to go into the site and calculate whether you qualify for that subsidy. So that is definitely an actionable item that they want to do, right, Ben?
Absolutely. A lot of value there for people who normally wouldn't qualify or prior to this plan weren't able to qualify. A lot of additional folks now who are going to be able to qualify for this special premium.
All right. So folks, hopefully you found that valuable. If that's you out there, absolutely give us a call. We'd be glad to help.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
Well, this week, as you can tell, we've got Banks here. She just keeps getting bigger. I thought it'd be a good idea to check in and see how she's doing with her sector investing, because if you've been watching the show, you know, about 4 to 6 weeks ago, we had her pick some sectors to invest in. And we wanted to see, you know, maybe she'd be better at this. We started off having her try to pick a stock, and, you know, she didn't do so well on that one. So we thought maybe that's just too much for her. So we tried sector investing. So I'm going to go ahead and take a minute. Let's go ahead and roll about a minute of that film. So you all, if you didn't see this, so you can watch Bank pick her sectors. Oh, she smells it. All right. First one she picked was cash. That's the first right now. Oh, there she goes. She went for gold. All right, puppy, there you go. Gold it is. So we have cash and we have gold. Apparently, Banks is going defensive on us. So, you know, all right, we're back. So, as you can see, when she picked the sectors, due to her choice of dog treats, I guess, she ended up picking cash and gold. Well, let's see how my baby Banks here is doing so far. So I've got the results here in front of me. Here we go. Over the last 4 to 6 weeks. I'm recording this about a month after she picked them, by the way. So after the first month, cash, well, you know what that's earning. Nothing, right? No, nothing for cash, Banks. And then gold, gold is up 0.74%. So if you would have taken your money and put half of it in cash and half of it in gold, which of course you would never want to do, but let's imagine you did, for the month, you'd be up 0.37%, or that's about 4.5% per year is what that works out to be. So that's not so shabby. Let's see how the other sectors did that my baby here did not pick. Yeah, you chose. So she did not pick. Here's what she didn't pick. She didn't pick U.S. stocks. Well, guess what? Those are up 0.44%, so those are doing okay. She did not pick international stocks. Now, that was a mistake. International stocks are up 2.5% for the month since we did this. I mean, that's amazing. But then she also did not pick real estate. Now, this may come as a surprise to you, but real estate's actually down 3%, 3.22. She did not pick the healthcare sector. Now, I know a lot of you, especially if you're retired, you are big fans of the healthcare sector because it's done so well historically. And I know you're thinking, healthcare is just going to be used more and more. And, with an aging population, all the advances, that's where the money is. Well, guess what? That sector's down 3.5% in the last month. So if you do the math, if you were to put your money in U.S. stocks, international stocks, real estate, and healthcare, say 25% in each of those categories, you'd be down almost 1%, 0.92%, which is the equivalent of being down 11% for the whole year. So basically, my girl here, she picked cash and gold. Let's be honest, we made a little fun of her, right? She picked cash and gold, but she actually picked the winners. Overall, her portfolio of cash and gold, after a whole month of measurement, you never measure anything after a month, of course, but we do on the show for my baby banks, she is beating the other sectors quite handily so far. Now, we're going to kind of check in on this from time to time. I know she was a little depressed when she picked Nike and it didn't beat Warren Buffett's investing, so she's a little down on that. But now, with this approach, maybe she's doing a little better, and maybe she'll give us some fun additional picks as the year goes on. So, folks, if you have questions on some of these topics, questions about anything, always feel free to give us a call.
The marketplace subsidies is a very important topic, and it's something that actually, if you've noticed, we aired this a couple of weeks ago as well, because we think it's vital that you're paying attention to this right now, and one that we encourage you, if you have questions about it, we have a team here that helps with that. And actually, Nick, you handle that in our Gaylord and Petoskey offices, and so much changing right now.
Yeah, if you guys haven't updated that yet, give us a call. I'd be happy to help. I just had a client recently who saved almost $300 a month on their premium because they now qualify for a subsidy because of that new legislation that Biden just announced. So it's very important, save you a ton of money possibly. Just give us a call and I can let you know if you'll save some money.
Yeah, and that's where, when we're looking at your overall retirement plan, again, it's one piece of that structure. I know on the show here we talk a lot about different income and investments and tax planning, but sometimes I feel like insurance, we're not maybe talking about that as much as maybe you want to be hearing. So again, that's where we offer that opportunity to talk with one of our team members and really dive into that to better understand where you are. The other one was bringing Banks, the dog on the show, was actually aired almost 5 years ago now that Mike film that, and it was really interesting to look back at that and sort of see, okay, what different sector of the market is Banks going to choose and how does that perform? And it brings to light a lot of the conversations that I have with clients as far as asset allocation. And so often, people look on the news and they'll see, oh, what did the S&P 500 do today, or the Dow or the NASDAQ? And a lot of times I think people think that that's what everything is doing, but they're not factoring in what are commodities doing, as an example, or what is fixed income? What's the bond market look like? What about gold and silver? And again, it just brings to light how important it is to have a diversified portfolio, because you can see certain days or weeks or months, certain sectors of the market will perform really well, and others may not be performing quite as well. So again, if you're not quite sure how your portfolio is structured, we'd love that opportunity to sit down with you for a no cost, no obligation visit, just to share with you how your portfolio is structured and some things that you might expect. So stay tuned, as we're going to be diving into ETFs and IPOs next.
At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show. Hi, in this segment, I want to talk to you about exchange-traded funds, or what we call ETFs. I got a call the other day. Somebody was looking to get into gold, and they wanted to know how they could own it physically. And I said, "Did you know that you could actually own it in an ETF?" And they're like, "I don't know what that is, Larry." And it just prompted me to, maybe take that situation and say, you know what, maybe this is something I haven't talked about on the show. What are they? First of all, understand that an exchange-traded fund is like a stock. It trades on stock exchanges, okay? It's a collection of securities, okay? So think of it as like a basket. And I can hold anything in that basket I want. It could be bonds. It could be, certain sector stocks. Like say I'm bullish on transportation, it can just hold transportation stocks. It can hold commodities like gold and silver. It can hold currencies, all right? Or you can have it be the inverse, which means it's short in certain sectors. So it's kind of betting on the opposite direction. It can hold cryptocurrencies. Now I've had people talk about this, Larry, I don't know how to go out there and buy Bitcoin. Well, did you know that you could buy an ETF that tracks, Bitcoin as far as the value? So very important to understand. Now, the first ETF came out in 1993. It was called SPDR, or SPDR. But the first actively traded ETF didn't come out till 2008. Now you say, what's an actively traded ETF? Well, remember, you got that basket of securities. There's no trading, right? It kind of closes, and now you're just tracking it like an index, right? Well, an actively managed ETF is following a manager, maybe a mutual fund, maybe a certain manager's top picks, and it's mirroring that and keeping that in the ETF and following it accordingly. Now, the pros to an ETF is you can trade them during the day, unlike a mutual fund, which trades at the end of the day. So if you're in a certain sector and you're seeing momentum in the stock market and you want to get out of a certain ETF, you can trade it during the day, just like a stock. Now, typically, you want to use an ETF too because they can sometimes be cheaper than going out and buying the stocks themselves. Think about it. If I have to go out and buy Amazon, as high as that is, but if I can buy like a technology ETF that holds Amazon in it, can be much cheaper. Typically lower costs with an exchange traded fund because there's not a whole lot of trading. Now, a disadvantage with ETFs is if it's actively managed, it's going to come with some higher fees. Again, you can trade these during the day. That's going to be a good thing. Sometimes it can be a bad thing if you own just a single sector because you may not be diversified like you should be. People ask about dividends and interest. Yes, they actually grow in the ETFs as well. So you're not just tracking the value, you're also incurring the dividends and interest that's growing within it. Another advantage is no capital gain distributions like you see in a mutual fund, right? They're not passing those on to the people that own them, so it can be tax efficient. So hopefully that's been valuable to you, maybe give you a little bit more understanding with ETFs. If you want to learn more about those, give us a call. Hi, in this segment, I want to talk to you about initial public offerings, or what we call IPOs. Listen, this is simply a private company, all right, privately held stock that now wants to go public. Now, they call this going public, right? And, so there's a process that happens with these IPOs. First of all, that private company has to sell it to an investment bank because they want somebody to underwrite it. All right, that means put all the proper disclosures together so they can go out and solicit interest from other investment banks, okay? So what's happening in this process is they're going out and they're selling the idea, they're soliciting interest from other investment banks saying, listen, are you interested in so many shares, at maybe a certain price? And there's this kind of supply and demand process that kind of happens in this behind the scenes. Now, why does a private company do this? Well, what they're doing it for is they're seeking to go public so they can have access to a large pool of investment dollars, okay? Before they had to peddle that kind of on their own, but now when it goes public, they got a large pool. Now, why do they want a large pool of assets? Well, maybe to pay debt. Maybe it's just working capital. Maybe it's money that they need to grow to the next level. Now, it also helps them if they go public. They might go for initial public offering because they need so many shares for growth, but what about growth down the road? Then they can issue more shares as it goes along. So you got this investment bank that's out there trying to solicit for interest from these other investment banks, and they call this basically the book building process, okay? And again, the supply and demand thing is happening behind the scenes, with these investment banks as far as how much they want to buy and what they're willing to buy it for. And then you have what's called the day of the IPO. Okay, this is what you hear on the news. This initial public offering is going to come out, and this is where you get a lot of hoopla, right? Because if this company has any kind of branding, you may be interested in getting on this in the early stages, right? So there's this book building process that happened, but now on the day of the IPO, there's more book building process going on, all right? Maybe some of those investment bankers see some excitement out there, maybe they want more shares, so that kind of happens a little bit during the day. And then it comes to a point where when that supply demand hits and they have enough shares they think is going to come out, now it goes public. And this is where everybody tries to jump in. Now, you got to remember with IPOs, there's some disadvantages, right? Now this company that was private is now publicly accountable. and as far as disclosure goes, they have to have prospectuses. And these things are very costly to form, but usually the benefits outweigh the cost because of the things I talked about earlier. So hopefully this gave you value. Maybe you see these IPOs come out and wondered what the process was. Thought you might want to know.
Really appreciate Larry diving into ETFs or exchange traded funds, and that's something over the past 16 years that I've been here at Centennial Wealth Advisory. We've seen a change of a lot of advisors in the past would more lean towards mutual funds, and a lot of the money managers today are shifting more towards the ETFs. It seems like a much lower cost option to still set up a diversified portfolio, which is important with any planning, right, Nick?
Oh yeah, absolutely. We've got a couple different strategies where we use multiple different ETFs just to track different sectors of the economy. So there's like a healthcare sector, a finance sector, commodity sector as well, where these clients get exposure to these different sectors without having to shop around for all these different individual stock positions. So it's very cost effective. And then also there's other ETFs where you're tracking specifically like gold and silver, which a lot of clients had no idea was out there, where they didn't actually have to purchase gold or silver. They could just track the spot price via this ETF and watch their money grow in the commodity space. So
yeah, and the nice part with that too is it's fully liquid and easily you can sell it on the market versus like mutual funds where you have to wait till the end of the business day and everything to sell. So that's another way that things are always picking up and changing, and something you want to be paying attention to. Along with that same topic, IPOs are a hot button topic right now as you see a lot of popular names out there. One that comes to mind is Airbnb and how they wanted that extra money into their business and everything, so they put it out as this public offering as investors are then anxious to get in, typically on the ground floor. And so you want to be looking at those, but also want to be cautious with them. As is true with any individual stock investment, there comes a great amount of risk, and so you want to be aware of what those risks are. So again, if you're looking at your portfolio and questioning, how your portfolio is structured, mutual funds, ETFs, along those lines, we'd love the opportunity to sit down and talk with you to better understand how you're positioned and see if it's something we could help you with. So thanks again for tuning in to Retiring Well.